Alrighty, hello and welcome. This is Dividend Grinder. Today, it's a Wednesday video. It's August 7th. Tomorrow's my sister's birthday. Yay! Anyway, so this one I'm going to be talking about buying the dip, going into recession. What's your plan? And this is a response to a comment, and I simply responded to it on the YouTube. I believe it was on my last video. Was the cash flow challenge one? Yeah, it was. So this is a question from Sean Gallagher, and it just says, can you talk about your strategy to handle a potential recession? And I said, simple, buy more, look for timeless companies on absurd discounts. I think that's pretty much the strategy for every single investor on earth. And then he says, yeah, but everything seems so overpriced right now. And then I respond, strategy doesn't change regardless of market conditions. So I want to kind of elaborate on that because this might not be true for other investors, especially dividend investors. So ultimately, because I am a high yield investor with some of my portfolio just going to flat out dividend indexes, and then the rest of it going to individual high yielding funds and stocks and REITs and BDCs and what have you. Because of that, my strategy doesn't really change. So today on Twitter, I gave the priorities for my portfolio. And it was to get my indexes up to $10,000. That was priority one. Priority two was to get my benchmark portfolio, the high yielder, up to $1,000. And then number three was essentially you could rephrase it as buy my funds that are not doing so well at the moment. But notice that's number three, not number one. So number one, I just want to get my indexes up very, very high. Up to $10,000 minimum. They're currently at, I believe they're at $5,200 if we look after I bought today. Yeah, so $5,261. I want to get that up to $10,000. I consider all of these indexes as one giant fund. I consider it as one stock, even though there's three individual pieces. But I consider it as one fund. So if you count that as one giant fund, it is the second largest position in the portfolio, right behind Realty Income Corp. But I want the indexes to absolutely demolish that. So for me personally, whenever we go into a recession, yeah, I'm going to be buying pretty much every single holding that I have as long as it goes down. But I'm going to be more focused on the indexes. And the reason for this is because not only is that where I'm getting my true diversification, but that's also the lowest yield for me. So you look at my portfolio, it's an entire high yield circus, if you want to call it that. Whoops. So we start at the top. Realty Income Corp, high yield. PIMCO, high yield. I think I can list off like the starting yields at the top of my head. Realty, like 4.1%. PIMCO is around 8%. GLPI is around 7%. Main Street Capital is around 5%. Stags around 5%. BlackRock Science and Technology, that's 5.5%. UTG, that's around 6 to 8. And then we have the benchmark portfolios, which those are really, really high up there. So the indexes are my lowest yielder, and that's currently at 3.1%. So my strategy for the recession is a little bit different than a lot of typical dividend investors. So a lot of standard dividend investors, probably a lot of people who watch my channel, they invest in more blue chip companies, right? The Coca-Colas, the Pepsis, the Johnson & Johnsons, Leggett & Platt, Lowe's, Home Depot, all that kind of stuff. And not necessarily getting the high yields right now because the market, you could consider it overpriced if you want to call it that. I think it's a touch overvalued, but not too much in all honesty. I think it kind of fits with how the economy is churning right now, at least in the United States. But nonetheless, a lot of these blue chip companies, they don't have high yields like a lot of my individual holdings have. So my strategy doesn't really change because of the market. Now, when all the stocks are really cheap, if all my funds go really, really low in price, I'm going to be buying pretty much everything in sight. But my number one priority right now is to get my index funds up and higher, and that's my lowest yield right now. These three slices I'm counting as one giant stock, essentially, one giant ETF, 3.16%. And then when the market goes down, this one's going to be my probably like 4% range. I'm hoping for. Yeah, that would be a little bit high, but I'm hoping it gets around 4% dividend yield when the recession hits, and then that's what I'm going to be buying because this is ultimately going to be the back driver of my portfolio. I want to get the indexes. It's currently, let's get the true numbers here. So currently, those three funds make up 16.2% of the portfolio, and I have them targeted to 25%. If I get to my goal of 10,000, it's going to be around 32% of the portfolio. I wouldn't mind if it got all the way up to 50. I really wouldn't, because this is something that I don't want to pay attention to. I want to put a lot of money and just set and forget, and I want to focus on the monthly stocks, because my monthly high yielders are something that I have to pay attention to very close, because there's a reason they have high yields. Even if they are REITs or BDCs, you got to be careful, and you got to make sure that you're on top of them at all times. Make sure nothing fishy is going on with them, because they are stocks that can immediately cut their dividends, or something could go wrong. Maybe they miss FFO if they're a REIT. Maybe if they're a BDC, something with the interest rates go out of whack, and all of a sudden they have trouble funding these companies that they're developing in. Maybe they have so many defaults from their lower EBITDA investments. Whatever the case may be, those are the ones that I really have to keep my eye on. So I wouldn't mind making a huge part of my portfolio indexes. I don't have to keep my eye on. And if I can buy my lowest yielders, which is at a 3.1% dividend yield, if I can buy that at around a 4% yield on starting cost, I should say, then that's what I'm going to do. That's pretty much how I'm approaching this. I'm going to fund very aggressively into my indexes, and I really don't care about the market turnout. Obviously, if if my entire portfolio gets cut in half, 50% in value, yeah, I'm obviously going to be buying my high yielders too, because they're going to yield even more, and it's going to compound even faster, get me to my goals quicker. But at the same time, I want the crutch of my portfolio to be in these high-yielding dividend indexes, and then if I can get that yield, if I can get my crutch to around a 4% starting yield, well, that's awesome for me. But this is going to be different for everyone else. So I have a different mentality, I guess you could say, is because I don't hold cash, and I got rid of my only bond holding, which was only $650 anyway. So I'm already in the high yields. I'm not holding cash. I'm not preparing for that way. That being said, I don't fault anyone who does that strategy. There's really nothing wrong with holding some cash or holding some like bonds or lower yielding but safe investments. I'm all for doing that rather than holding cash, because I think holding cash is an absolute waste. You're just losing out on potential yield, and there's no reason that you should just hold straight cash unless you're getting some kind of interest return on it from your brokerage. Obviously, you can't get that on M1 Finance, so I had it in a short-term bond yield. You might as well get some yield. I actually got the only dividend payment I'm going to get from them, $1.32 today. Nonetheless, whatever strategy you want to unfold is fine. Just make sure you have a plan, which gets into my next point. So, obviously, on Monday, everyone was having a comment on the market going down. It went down, like 3.5%, close to 4% on the NASDAQ. And everyone's like, oh man, can't wait to buy the dip. Can't wait to buy the dip. Can't wait to buy the dip. I'm deploying more cash. You would be surprised how many people I saw selling out of positions and buying into other ones after this 3.5% dip. And I also saw people that are all of a sudden funding it so heavily off a 3.5% dip. Guys, the S&P 500, even after that dip, is still performing well over 10% for year to date. So this isn't a dip, is what I'm trying to tell you. And just because the market dips a little bit doesn't mean you have to go so aggressive into the market. And I think this is the kind of the mindset of the new investor. They see their positions go down, and as a new dividend investor, they're like, oh, okay, the best thing you can do is buy value and buy when it's cheaper, lower your dollar cost average. So they immediately start funding heavy. And if you're a person that reserves cash or reserves it in some low yield funds until the best opportunity comes along, down 3.5% is not your best opportunity. That's all I'm going to say about that. There's really not much more to say. You're really holding. If you truly believe that a recession is coming and you're holding cash, or you're in low, very highly liquid funds, low yielding funds that are safe but highly liquid, if you're in that type of mentality where you think a recession is going to hit, then why on earth would you start deploying at minus 3%? You want to just do what you usually do on a day-to-day basis, and then when the market starts dipping 10, 15, 20, 25%, that's when you start getting involved. That's when you start buying a little bit more aggressively. If that's your mentality with a recession, there's nothing wrong with that mentality at all. That's pretty much the dividend dream, right? All the stocks go 50% on sale and you get the same yield on cost, or the yield on cost is going to be even higher because the starting yields are higher, and then you buy low. That's pretty much what everyone plans on doing, right? Well, don't do that if it's only minus 3%. Keep your reserves intact. I mean, the market dipped 3.5% yesterday. I did a deposit of $35. It would have been $30, but I got a bonus on Mechanical Turk. So I really didn't treat it as any different than any other day. And likewise, yesterday and today was pretty much just a flat day. And, the mentality was, if you spent so much on that minus 3.5% day, then you should have been going just as heavy yesterday and today, because it was kind of pretty much flatline from where it was end of day on Monday. Yeah, it went up a little bit yesterday, but not that much where it'd be like take away from that full dip effect. It was still down like 2.5% overall. And then today was essentially flat from that mark. So if you bought Monday, you had to be buying heavy Tuesday, Wednesday, right? And if you say no, that means you get too caught up in the one-day dips. And this can be problematic. You have to wait for your turn. If you're reserving cash or highly liquid accounts, you have to be ultra patient. And I know a lot of people don't like to hear that, but if you have the patience to reserve the cash, then you should definitely have the patience to execute the cash when the time is right. I don't fault you if you do it when it's down like 8% or 10%, maybe even like 6%, double what we saw on Monday, because then you can see, okay, there is actual true value. But 3.5%, that is, guys and gals, in the long run, that is absolutely nothing. And it's funny because so many people will buy off a 3% dip, and let's say you're buying Coca-Cola and it's like off that 3% dip, Coca-Cola probably went a little bit less because it's a consumer staple and they typically do a little bit better in these downturn situations. But nonetheless, I mean, you're buying for the cash flow, right? For the dividend. And a 3.5% drop is like buying a starting yield of like 3.9% versus 3.8%. I mean, you're splitting hairs. So that's why the strategy for me is pretty much go business as usual, because my yields are already super high. And I'm essentially just buying the lowest yield in my portfolio. I'm going to be continuing to do that in a market downturn. I'm just going to go really heavy on the indexes because that's the lowest yield in my portfolio. I don't have to worry about necessarily getting the yield on cost on my high yielding positions, which is half the portfolio. That's just my mentality. Everyone has their own strategy for the recession. That's just how I go about it. It's kind of business as usual, to be honest. I'm going to be buying a lot of indexes. I shouldn't say a lot of indexes. I'm going to be buying the same 3 index funds that I own right now, trying to boost that to pretty much double the size that it's at now. And if we get to a recession, that's the one where I'm really going to be going heavy because it's my lowest yielder and it also gives me that diversification. I want it to be the crutch of the portfolio. Hope you enjoyed this video. Just a little bit talk on recession and buying the dip, which I got to be honest is a term that I'm really starting to hate because whenever the market drops 1%, you have all these newbie dividend investors coming out of the woodwork saying, buy the dip, buy the dip, buy the dip, buy the dip. And they're just throwing it around and they assume that every red day is a dip. And that's not how a true buy the dip is. You shouldn't say buy the dip. You should say buy the value. That's really what you should be focusing on because 3.5% is not value, especially when you're a long-term dividend investor, especially if you're a dividend growth investor. 3.5% dip in your stock is nothing. And a lot of the seasoned dividend investors will tell you that's nothing. You see that kind of stuff all the time. It's going to be happening all throughout until the election ends in next year. You're going to see these highly volatile days, news of China, news of the currency war, what have you, any political findings they have with Trump or, maybe Bernie Sanders wins the Democratic vote, whatever the case may be. You're going to see these high often days. So you can't consider just a 3% drop and then the rest of the week's flat as like a buy the dip situation. Buy value. That's the whole point. Hope you enjoyed this video, Dividend Grinder. Let me know your thoughts in the comments below. I will jump in as I always do, and I will give you my perspective on whatever you say. So see you guys tomorrow on the Spicy Dividend Podcast. I thought last week's podcast was probably my best podcast, by the way. So I'm hoping that tomorrow can be just as good. A lot of philosophical stuff, not going to lie.